Alright, so now let's take a look at the liquidity grab. This right here is one of my favorite smart money concepts because they can very often be great entry signals, and it's also pretty easy to, set your stop loss and target level from these liquidity grabs. But first of all, we need to know about something called liquidity zones. And liquidity zones are basically areas with a high concentration of orders. So these are areas on the chart where we, for example, have many stop loss orders or buy orders that are waiting to get triggered. And the theory here is that large players, aka smart money, often tries to push the price down or up to trigger these orders. And when these orders get triggered, this will create liquidity for the smart money. So for example, let's say that we have a very clear support level right here. And because we have a support level that is very clearly visible on the chart, it's likely that we have many stop loss orders placed just below this support. So smart money might push the price down in order to trigger these orders. This in turn will create more selling pressure, and smart money then uses the selling pressure to buy a lot at a cheap price. So this will in turn push the price up. And because the price broke the support right here, this will often lead to many traders actually entering a short position, betting that the market will continue to fall. And when you enter a short position, you place your stop loss above the current price. So now we might have many stop loss orders at this point. So you can see that when smart money pushes the price above once again, this can in turn trigger the newly created stop loss from the short traders and create even more buying pressure. So as I just explained, the market often reverses after the liquidity grab due to the temporary imbalance that is created. And we as traders can use these reversals as potential entry points. So right here we have a classic example of a liquidity grab. First of all, you can see that this market is in an uptrend. We're printing higher highs right here and higher lows. But at this point, we can actually see that we had a liquidity grab. And now you might of course wonder, when the price falls below this point, like we did right here, earlier in the video we have learned that this is actually a change of character. So why is this not a change of character? Well, for this, different traders will have different methods, but what I usually look out for and what I want to see when I see a liquidity grab is that I want to see a candlestick that wicks below the support or resistance and then very quickly pushes above. So we might, for example, have a hammer candle that looks like this. This right here is a clear indication of a liquidity grab. And this is also the reason why, in order to see a true change of character, what I'm looking out for here is that I want the candle to close below this low point right here. So in order to have a real change of character, I usually want to see price action that confirms the change of character. So it's very important to actually analyze the price action at these critical market structure points. And by the way, guys, if you want to learn more about price action, I actually have a full video course on the topic. So I will make sure to link that video up in the corner, and I highly recommend all of you guys to watch that video after you have seen this one. Alright, so now let's take a look at how to trade liquidity grabs. And the first thing we can notice about this chart is that we are in an uptrend because the price continues to break structure while at the same time maintaining the lows. Right here we printed a new high. But here, on this green candle, we can see something very interesting. We can see that the price quickly pushed above the resistance level we need to create yet another break of structure. But since the price pushed above and then immediately saw a sharp movement to the downside, this is actually an indication that we are seeing a liquidity grab. So here it's possible that smart money triggered multiple stop losses that is placed just above this high. Then they might have used this liquidity to buy a large position, and as a result, the traders that bought this breakout that is likely to place their stop loss orders below this point might in turn get triggered and lead to even more downward pressure. And one thing I really like about liquidity grabs is that it's pretty easy to manage risk and to enter around these liquidity grabs. So one of the most common way to enter is to simply enter at the candle close of the candle that caused the liquidity grab. The stop loss is usually placed above the highest point of this candle, because if the price pushes above, we have yet another break of structure, and this indicates a continuation of the uptrend. As for your target level, a common method is to use a simple risk to reward, so you can measure this length right here, and a risk to reward ratio of 2 would set your target around there. This video was just a very short clip from our full smart money concepts trading course. So if you have the time, I highly recommend to click or tap on the screen right here to watch the full video.